The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
We are live from Studio 2 at Bloomberg headquarters in New York. I'm Alex Steele.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. on this, do we call it Fed Day Eve or Fed Day 1?
No, Fed Day Eve.
Fed Day Eve.
No, I'm into Fed Day Eve, but I see your point. Yeah. So it's been a tough day for the markets overall, anywhere you slice it. But we talk a lot about bad breath in the market and just how bad that breath is. Now, this chart really encompasses that. So the S&P is down 0.5%. NASDAQ 100 down 0.6, but the equal weighted index is down 0.8%. It still shows that out of all the losers, you still have big tech holding up relatively well. Charlie McGilligot over at Nomura had a good one that said that lots of leveraged funds are grabbing call upside for the names that are doing really well. So think that mega cap tech trade. So you have that animal spirits just continuing to pile onto each other, leading to even more bad breath, and the cycle just continues, Scarlett.
And that really sums up the picture here as we await tomorrow's Fed decision. Stocks may be flashing a sell signal. Bank of America says fund managers are loading up on U.S. equities, and they're cutting their cash holdings as a percentage of total assets to a new low, 3.9%. That is a level that historically has ushered in a wave of selling the following month.
All right, for now, though, revving up on the economy. Retail sales surprising to the upside as people bought more cars in November, and Black Friday sales come in strong. This raises questions as to how the Fed will describe the economy. Bloomberg Economics says a rise in the use of the word careful could coincide with a pause.
No pause seen in bond yields, though, at least according to T. Rowe Price, whose fixed income chief investment officer is calling for the 10-year yield to reach 5% in the first quarter, before climbing even further, maybe to 6% for the first time since Y2K. This as the incoming president's policies, whether it's tax cuts, tariff, or immigration, keeps inflation elevated while budget deficits persist.
So let's get more into the Fed and sort of how they're going to categorize the economy. This is a great chart from Bloomberg Economics, and they point out that hikes and pauses and cuts can somewhat be dictated by the use of the word careful. So if you look at the sub-zero line, that shows how little the words careful are used within Fed speakers and Fed statements. If it goes into positive, it means that it's used a lot. And when it's been used a lot, if you take a look back and say August of 2023, nothing happened. There was a sustained pause, no cuts, and no hikes. When that reading is low, you get a lot of movement within the Fed funds rate. And we're just seeing that line go into positive territory, Scarlett. So you wonder, is this the moment where we're going to see potentially extended inaction?
All right, we're going to continue to monitor that. In the meantime, let's kick things off with Bank of America. The chairman and CEO, Brian Moynihan, joins David Weston.
For our Bloomberg audiences worldwide, I'm David Weston. I'm delighted to be here with Brian Moynihan. He, of course, is chair and CEO of Bank of America. So, Brian, thank you for having us here to your trading floor.
Happy holidays first, David.
Yeah.
Thank you for coming, and all these teammates have been here all day waiting for you. So
You're waiting for something, probably making money for you. So let's talk about the economy first overall. I think it's fair to say it's doing better than most people thought it would do. Is there any cause for concern it may be overheating, particularly as we see some new policies maybe coming our way?
So I think let's start on the first part of that question. If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted. And a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a bounce anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm and discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times but stays 3.75 to 4. And they predict it takes inflation all the way into 26 to get down to the target. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Let's stay on the consumers here, because you know so much about the consumers here at Bank of America, given your relationships. How is the consumer doing? I know they're spending, but I've seen numbers that suggest they're borrowing more. And in fact, St. Louis Fed has new numbers out from as of October. The defaults are up as well. Are you worried at all about the consumer?
So this is go back to what you're thinking about, which is if you say the levels of consumer credit card debt are above where they were in 19, it's 5 years later. They should be above where they are in 19 because the economy is 30% bigger. So a lot of these nominal numbers, forget to put them in relative scale. If you look at it on a relative basis, it's still far below where it was in 19. And the credit was very good then. If you look at the defaults, they picked up a normalized defaults and delinquencies to where they were in 19. 2019 was a 50-year low in credit costs in our company. 50 years we had to go back to find. So we got to be a little careful about what we're comparing to. Everything's steady and fine now. Credit quality consumers, their ability to borrow, the household income, they feel a pinch of higher prices. Part of that is real, and part of that's just mental. If the price of eggs doubled, it's hard to ever tell anybody it's okay because they have more wages. They're just never going to agree with us, and that's the economist's view of an economy versus human beings' view. But all things, if they wouldn't be spending money the way they are in a rational way at 5% year over year for the last couple of weeks, 3.5%, 4% for the month of November, and likewise it looks like that'll be December, if they didn't feel confident. And why is that? All comes back to one thing: 4.1% unemployment rate, wage growth of 3%. That's the core. Now, what could disrupt that? A lot of things, but right now that's the condition of the American consumer. They have the ability to borrow, and they're borrowing rationally. They are employed. Their wages are going up. They feel the pinch of inflation. They're trying to work that all through, and they're trying to have a good holiday season. So we'll play that. What will hurt that worse is unemployment moving up, and right now that's not projected to happen at all next year. It's supposed to go, our team has it 4.3 at year end next year. You and I have been, for most of our business careers, we've been jumping over this, the moon if we thought unemployment was 4.3 for 2 or 3 years in a row or less.
Take all of that economic data, put it all together, and tell me what the Fed should be doing. They're meeting today. We'll get a decision tomorrow. 25 basis points seems to be baked in as a cut. But should it be cutting further beyond that 25 basis points, given the strength of the economy and all the things you just said?
If the economist's view is you have to have a real rate structure across the curve of 75 basis points, 100 basis points. If you're 475, 450 now, and the inflation rate's 3.3, that's bigger. So you got to start to bring it in normalized. We got to get to, positive sloping curve, a curve that has real rates across it. An inverted curve means something anticipatory is going to go the other way. All that's got to happen. So I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariffs and stuff, but wars. What happened in the Middle East the week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States ultimately and reverberate with them because we sell a lot of goods in a lot of these countries. And by the way, we buy a lot of stuff from these countries. And so, we're inextricably linked with the outcomes of some of these things. And so we have to be careful. But if you look at it in the U.S., they ought to cut rates, bring them, our team's view is they bring them down to 375-ish type of level, 3 more cuts from where they are today. But they'll be higher in the current context. But if you look back excluding 2008 till now, a 3.5%, 3% Fed funds rate is the norm, not the exception. It's only been the exception in the last 15 years.
But it is different from what we thought it was going to be. It's higher, I think.
Yeah.
The neutral rate's higher than it was. How does that affect your business, if at all?
Well, the question of, everybody says the higher rates help higher rates. The question is why they're there. If we had a normal rate curve from, say, 3.5% on the front end to 4.5% at the 10-year, and the economy was growing at 2%, that's a very good place for banking. Delinquencies would be low, cost of credit and its availability is there. Our deposits are better suited at a higher nominal rate because when they go down, we have zero floors on a third to half of our deposits that just can't go any lower than zero unless we start charging people to give us their money, which isn't going to happen. So it's better for us. But if the reason why they're higher is to choke off inflation, that can be not so good because that will probably lead to recession. So the question of what's the underlying economy doing less than the rate structure. And the underlying economy right now growing at 2.5 with a 3.5 to 4% Fed funds rate and a 4.5% 10-year rate would be great for our industry. And that's why NII just keeps growing every quarter. We were at 13.9, 14.1, 14.3, and you expect that growth to continue. And it's just walking up a ladder back to a level, and the peak we were like 14.8 or 15. So
we have people out right now saying not 4.5, maybe 5% or even 6% on the 10-year. Do you put any credence in that?
Our team doesn't see that, and I have to rely on the experts that spent. We wrote a research paper with a 5,000-year interest rate, low in interest rates, and I said, "How do you know that?" And they said, "Well, we went back and did research." So we have Candace's team's a powerful team and the best in the business. So they think it's 4.5 is just kind of where it is, and as the rate structure comes in. Is there potential for that? Yeah, that's probably when something else is going on that is not good, and therefore there'll be faster adjustments which might bring it back in. But you think about it, to go from a 1.5% 10-year to a 4.5% 10-year, that's a lot of movement, and it's very restrictive on activity till the activity adjusts out of that, and that's what we're seeing now.
You mentioned Donald Trump returning to the presidency next month now. How do you take that into account at Bank of America? I mean, what do you anticipate? We don't know exactly what will happen, when it will happen. So how do you plan for that? What will it mean for Bank of America, do you think?
Well, so I think one of the larger contexts is the oldest part of our company has been around for every presidential transition except for George Washington. So we've been through this before, we'll be through it again. But the real fact of the matter is, if you think about what the policies are that President-elect Trump got elected on, it's inflation and immigration stuff, but it's also about deregulation. And our industry needs to have a sober look at what the right regulation. 15 years ago, 16, 17 years ago, after the financial crisis, we had to put new capital, new liquidity, and restore the confidence of America. Since 10, 12 years ago, the capital is about right in the industry, yet we kept ratcheting it up. When we ratchet up capital, that draws down our ability to lend. It makes credit harder to get and more expensive. And on a worldwide competitive basis, our capital ratios are much higher. And then the day-to-day supervision. So the idea of bringing that regulation back in the middle, and then, frankly, for the good of the industry, getting it settled someplace so that we can build a model around it. What happens now is we do this. And so we're hoping it brings it back to the middle. That's what and by the way, that's what our customers like about their industry. So whether it's the FDA, FTC, getting deals done, the enthusiasm, it's all about, wait a second, now we can swing it back to the middle and go get stuff done and make the private sector, which is the reason why America's successful, lead as opposed to the governmental sector.
So when you hear about a pledge for deregulation, is the main thing you hear with your Bank of America ears on is the reserve requirements?
Capital reserve, liquidity, CCAR, there's 1,000 different things. What I really hear about deregulation is our clients also saying, let's do deals, including our banking client. We have our investment banking bank clients, and you've seen 4 or 5 deals passed. The other day, the selling company in a transaction won't sell if there's a lot of uncertainty around it. No matter what the value is, if I don't think it's going to get done, I don't sell. That's what was going on for the last few years. Any deal of size was going to get hung up somehow, unless it was so different. It was like a private equity firm buying a company had no other firm. And that's not good for letting these American companies get more successful and grow. It doesn't mean you're going to be anti-competitive. It doesn't mean you're going to have that. There's huge price desire in the market. There's great competition, all that stuff. What it means is our companies can grow and make the kind of strategic choices. That happens in the banking system. We can't do any acquisitions, but it happens to our clients. It happens around us. That'll be good for us. But in ours, it is about capital liquidity and day-to-day supervision.
What is the biggest change coming up for Bank of America because of this new administration, do you think?
I think it'll be the economic atmosphere of deregulation, how it applies to us specifically, how it applies more generally. And that will be good. Now, we got serious issues, as I said, around the outside world. We got serious issues of what the right balance to get the debt back in line with our GDP and keep it there. But those issues are not new, but they have to be dealt with because we've been, in some ways, not dealing with the debt issues or not dealing with immigration since I've been CEO. We've been talking about solutions here. And we got to now start to implement some of those to just bend the curve of debt growth, get more and more, cash in to cash out as more rational position, and then and hopefully if you get the regulatory policies, you outgrow that. And that's basically what our research team thinks. They've added a little bit to their growth since then, saying that combination of policies, some offset each other, some will add to it, but in the end of the day, it'll be a little bit more growth oriented. We'll see what happens.
Brian, thank you so much for being on Bloomberg. That is Brian Moynihan. He's chair and CEO of Bank of America. Back to you.
Our special thanks to David Weston, Bloomberg's Wall Street Week anchor. Really interesting what he's saying about the state of the economy, that the Fed should be a little bit careful and go on rates a little bit carefully because the economy is still doing really well, and saying, like, look, yeah, consumers are borrowing more, but that can be healthy. As long as they have jobs, we're okay.
I really like the question David posed, though, about whether the economy is overheating and whether we need fiscal stimulus at this point. And Brian Moynihan was careful to say, well, probably not, but we also probably didn't need it back in 2021 when the current administration also enacted a lot of stimulus.
Right. Maybe not at the time because of COVID. Anyway, let's get a check back in here on the markets. We are still seeing equities trade a little bit heavy as we go into the close. Also seeing a bond market honestly not doing that much. Staying with the bond market for a second, T. Rowe Price projecting the yield could hit 6% next year, which Scarlett mentioned at the top of the show, and 5% in the first quarter. Here with more and get her take is Stephanie Larosiliere, head of fixed income business strategy and development with Invesco. Stephanie, thank you so much. 6% caught my eye. What are the conditions that you would think that we would see 6% next year?
Well, we're not necessarily calling for 6% on our side. I'd say that's a little bit higher than our expectations. But right now, we're really in a Goldilocks sort of situation, right? When we look at risk assets, we're in the perfect environment for them. We look at investment grade credit. We're talking about better liquidity. We're talking about, higher average credit qualities in that market. We're talking about shorter durations than we've historically had. All of that really in a credit market that seems tight actually allows for room for more tightening. So we actually think that, there is some more tightening to go in the credit market. We like investment grade credits, but certainly aren't stretching for credit at this time.
Okay, so when it comes to what is being priced in, with the bond market basically doing not a whole lot of anything today and equities slightly under pressure, I think pretty much everyone's looking for what has been described as a hawkish cut. What does a hawkish cut look like to you, Stephanie? I mean, I get that the Fed is going to cut rates tomorrow by 25 basis points, but how does it unfold in 2025?
So we do agree tomorrow, 25 basis points. As it relates to 2025, I think we're in a different space. Post-election, in light of what we've been seeing for the last couple of weeks here, in light of all of the policy rhetoric that we've been hearing, we do believe that we're probably going to see two cuts in 2025. We expect a total of 50 basis points. We think it's going to be data dependent. We don't necessarily think January is off the table, but we do lean more heavily towards March and June for the two cuts there. And we think the Fed will be paying attention to all the moving parts and making their decisions as the data gets released.
Stephanie, do you think the credit market accurately reflects just two cuts versus more?
I think right now the market is accurately reflecting what we're expecting. I think the thing that we can't necessarily price in at this point is the mass deportations, right? And all of the rhetoric we've been hearing about that. But there are some animal spirits, right? So when we think about the last Trump administration, we think about the corporate tax cuts that were made there. There's a lot of very strong positive momentum that can be had, as it relates to corporations, deregulation, as we heard Moynihan mention in the previous interview. I think all of those things will bode positively, but again, there's a lot of mixed uncertainty past that.
In terms of the long term, and I know we can't really project out a lot of Trump's policies, but we know that his Treasury Secretary is keeping a very close eye on the deficit and reducing the U.S. federal deficit, which is projected to top 6% of GDP next year. What are you thinking, or what do you think the bond market is thinking in terms of concrete steps that he might actually take in the foreseeable future to start addressing that?
So when we look at what can actually be cut, and we hear the rhetoric of various topics that have come into play in terms of what they plan to cut, there's very little room for the types of cuts to the size and the magnitude that we've heard discussed. So we are watching the situation, but it's really unclear, again, how much they'll be able to cut, because we're talking about things that really they don't have the bandwidth to actually make the types of changes that have been discussed.
All right, Stephanie Larosiliere, thank you so much. Stephanie is head of fixed income business strategy and development with Invesco. Just some breaking news here. This shooting suspect behind the insurance CEO, United Health, has been indicted for murder in New York. Once again, let me just repeat that. The insurance CEO shooting suspect, Luigi Mangione, has been indicted for murder in New York. We'll keep you appraised of any further developments on this developing story. First-degree murder, I should mention as well. Coming up on Bloomberg Markets The Close, we're going to have our top calls where we're going to discuss how grocer Albertsons is set for growth now that its deal with Kroger is definitely a thing of the past. This is The Close.
Time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And today we're looking at a bullish call on Albertsons. Shares, though, down over 3% despite an upgrade to outperform from Telsey Advisory. Want to bring in Joe Feldman, Senior Managing Director and Assistant Director of Research at Telsey Advisory Group. All right, Joe, walk me through your upgrade here.
Yeah, so we were thinking, we've met with the management team, CEO, CFO yesterday, and had a good conversation about all the different strategies that Albertsons has in play and has been working on over the past couple of years. They were not just sitting idle during the merger acquisition by Kroger, or the attempted merger by Kroger. They were actually working pretty aggressively to continue to improve technology, improve merchandising, better improve the real estate that they have, and be smarter about how they're using their systems to support the customer better, leveraging the loyalty program. All of these things should help drive growth in the future as a standalone company. And when you look at where the stock's valued, it's just way below where it's historically traded.
Is there any room, Joe, is there any room here for other kind of M&A, or do you think it's a really go it alone at this point?
You know, I think they would be open to looking at other things, maybe from their standpoint. They always, every management team I've ever met and spoken with, and actually we spoke to them, Albertsons yesterday about this, they're open to conversations. Everybody's open to that. And actually the way the FTC lawsuit against the deal really does open things up. In theory, Albertsons could merge with Trader Joe's or Aldi, or Amazon could merge with them. And, you know, it's really opened it up because the definition of the grocery market was defined so narrowly by the FTC. So we'll have to see how that plays out. I don't think that's what they're looking for growth in the near term, though.
Okay, maybe not for growth in the near term, but part of their argument, and Kroger's, was that they need to be able to compete against the likes of Walmart. So how does Albertsons do that in the meantime?
Well, so Albertsons, really interesting. They have kind of a decentralized buying process right now where a lot of the different divisions will buy and then they'll kind of roll it up, but they don't fully leverage the scale of their purchasing power. And I think going forward, we're going to see them go to the consumer product companies and working more aggressively to negotiate better purchasing power. So we'll have to see how that plays out, but I think that could be a good win for them.
The other thing is, of course, this merger is off with Kroger, but Albertsons was very quick to sue Kroger because they felt that Kroger didn't fight hard enough for the merger. Is this going to be a distraction? Is this going to take up a lot of resources and attention that it should otherwise devote to building out its business?
I don't think it's going to be too much of a distraction. It will be for the lawyers. The lawyers will be very busy with this. But in terms of, CEO, CFO, I think their focus is going to be right on the business and trying to grow the business with this, like these 6 strategic pillars that they've talked about, and being able to drive that growth. The distraction of the lawsuit, yeah, maybe they get roped into that a little bit, but I don't think that's really going to be a big issue for them. I think they're going to be able to drive better operational improvement through the business and continue to sustain pretty solid ID sales growth.
All right, well, we'll look ahead to see if maybe there is some kind of tie-up with the Trader Joe's or an Aldi's down the road. Joe Feldman over at Telsey Advisory Group with an upgrade to Albertsons. Coming up, how are small businesses feeling heading into the new year? We're going to discuss with Brad Close. He is president of the NFIB. This is The Close on Bloomberg.
Right now, the economy is moving along. Consumers are spending. It's up for the 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit in the summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy.
That was Brian Moynihan, Chairman and CEO of Bank of America, earlier on the Countdown to the Close. I'm Scarlett Fu.
And I'm Alex Steele. It's a tough day for the equity market, particularly if you look at small caps really underperforming on the day. What's interesting, though, is I keep reading research that says actually now should be a really good time to buy small cap stocks.
Yeah, there's a Bloomberg News story that says that small caps are entering a period that's seen a 21,000% return. Historically favorable period. There's a couple of reasons why, technical reasons among them. But, we've seen small caps already get a big leg up following the election of Donald Trump. He's seen as pro-growth, and that, gives a big boost to these laggards that have really, have not seen the benefit of investor interest for most of this year.
Yeah, and not to mention that, but you look at the recent NFIB data and sentiment survey, and you've seen it increase since August and really also taken off after the election. So can we put those two stories together? I wanted to try and do that right now with Brad Close. He's president of the National Federation of Independent Business. Hey, Brad, walk us through the increase in sentiment we've seen since August. What are small businesses most excited about right now?
Yeah, well, I think in a nutshell, economic policy matters. And there's no doubt that the election results spurred a lot of the optimism, that surge in optimism that we saw in our monthly economic survey. Small business owners are looking forward to an administration coming in that's going to address the concerns that the little guys, half the economy in America, really cares about. And that's tax policy, that's cutting regulations, and getting the economy going again.
This feels a little bit, though, like 2016 and a redux of the kind of sentiment that happened after that. Is that a playbook that we can look at when it comes to policy and small businesses?
Well, I think if you look at one of the biggest issues that small business owners are concerned about, the small business deduction, their ability to deduct 20% of their small business income on their business taxes, that's huge. That was created in 2017, right? So the economy took off after that tax bill went through. That policy expires in a year. Small business owners know that. And they are very optimistic that the incoming administration, which has said that they want to extend and make that provision permanent, is ready to get started on that.
So, Brad, I'm sure you heard us talk a little bit earlier about how small caps are entering this historic period where they tend to do really well and outperform the big caps. Is there a relationship between small cap stocks, the performance, the price action, and small business sentiment? Is there any causation, or is it more like correlation? How are your members thinking about that?
Yeah, I'm not sure I would be able to make that comparison. When you look at NFIB, our typical member is 5 to 10 employees, which is very reflective of the small business market across the country. So we're talking really small businesses all over the country. They tend to come more slowly out of bad economic times, and certainly the last 3 to 4 years have been very hard on that half of the economy, the small business side. But when you look at the optimism that you saw, I think that is a significant precursor of what we're going to see over the next 6 months.
Yes, but still going forward, there's still a lot of things for them to worry about. You still have interest rates, borrowing costs that are fairly elevated, even with the Federal Reserve expected to cut rates tomorrow. What are you hearing from them in terms of the number one obstacle that they face in 2025?
Well, unfortunately, right now, it's still inflation. That's still our number one problem facing small business owners, and that's been the case now for about three years. It's been hard. It makes it very difficult to operate. Small businesses have very small margins. They can find it very hard to raise prices, where bigger businesses have an easier time doing that. Right. So I think we're going to see good things going forward, and this survey really indicates that.
What about tariffs, though? It does feel like on that end, tariffs might hit your members particularly hard.
It may not. I'd say right now it's hard to tell. We'd really want to see some more details. That hasn't popped up in any of the surveys, any of the meetings with members that we've had. But certainly as policies become more clear when the new Congress comes in, that may be a different story, but I just can't answer that at this point.
Okay, we'll definitely check back in with you on that. What about the object of immigration and employment?
Yeah, I think for members, for small businesses, they have struggled to find qualified employees. It's been tough, but again, hard to say if that's going to hurt small businesses or not at this point and what that policy is going to be. But certainly they've been operating in a very difficult and challenging environment the last 3 or 4 years. So they know what it's like to get through that. But really, when you look at these numbers, there's not a whole lot of concern going forward.
Okay, we have to leave it there, Brad. Thanks a lot, Brad Close, president of the NFIB. We all now want to return to that breaking news on the shooting of the United CEO, Brian Thompson. District Attorney Alvin Bragg is speaking to reporters now on the charges.
Mr. Thompson's loved ones and colleagues, his family deserves our respect as they continue to grieve. Our work will never be able to undo the fact that a life was lost. We are here to announce that Luigi Mangione, the defendant, is charged with 1 count of murder in the first degree and 2 counts of murder in the second degree, including 1 count of murder in the second degree as an act of terrorism for the brazen, targeted, and premeditated shooting of Brian Thompson, who, as you know, was the CEO of United Healthcare. This case was made possible by the collaborative efforts of the phenomenal public servants you see before you today, and so many others who are not here. I'm honored to lead the Manhattan District Attorney's Office and privileged to serve alongside Assistant District Attorneys Joel Seidman, Kristen Bailey, and Zachary Kaplan, who were working from the outset, hand in hand, with the greatest police department in the world. The chief of our trial division, Lisa Del Pizzo, and the deputy chief, Chris Prefos, provided sage oversight and direction. And I want to acknowledge our high technology analysis unit. There was a lot to be processed here. Steve Moran, in particular, who heads that, and Marco Popic. We are privileged here at the DA's office to work every day with the phenomenal public servants at the NYPD. It has been a distinct pleasure to work besides Commissioner Tisch, an exemplary partner, and Chief of Detectives Joseph Kinney. Almost every day we're in touch, and his leadership is second to none. And then Deputy Commissioner Rebecca Weiner, who, as I tell her, there are a lot of challenging things happening in the world, and I sleep better at night knowing that she is the Deputy Commissioner in charge of terrorism. The detectives on this, out doing the courageous frontline work, Detective Oscar Diaz, Detective Curcio, exemplary, the finest. It wasn't just those of us here in New York. I want to acknowledge the great work of our partners in Altoona, the Altoona Police Department, the Blair County District Attorney's Office, the governors of New York and Pennsylvania, the FBI, and of course, the brave members of the public who answered the call when our great commissioner put out the call for their assistance. This was a frightening, well-planned, targeted murder that was intended to cause shock and attention and intimidation. It occurred in one of the most bustling parts of our city, threatening the safety of local residents and tourists alike, commuters and business people just starting out on their day. Let me say a bit more about the charges. They include 1 count of murder in the first degree as a killing in furtherance of terrorism, 2 counts of murder in the second degree, 1 charging that the killing was done as an act of terrorism, and the second pertaining to the fact that the killing was intentional. The maximum penalty possible for murder in the first degree and murder in the second degree as an act of terrorism is life without parole. The maximum penalty for murder in the second degree is 25 years to life. There are additional counts as well. A number of criminal possession of weapon charges, 2 counts in the second degree, 4 counts in the third degree, 1 count in the fourth degree. and a count of criminal possession of a forged instrument in the second degree. Let me tell you a bit about the facts. On November 24th, we allege that the defendant arrived in New York City to murder Brian Thompson. After the defendant arrived in New York City on a bus at Port Authority, he checked into the hostel on the Upper West Side using the name Mark Rosario with a fake New Jersey ID. On the morning of December 4th, the defendant left the hostel, just after 5:30 a.m. and traveled to Midtown. For nearly an hour, we allege the defendant waited in the area near the Hilton Hotel, waiting for Mr. Thompson to appear. From 6:38 a.m. to 6:44 a.m., the defendant stood across from the entrance of the hotel on West 54th Street. When he saw Mr. Thompson, he crossed the street and approached him from behind. We allege he then took out a 9mm 3D printed ghost gun, equipped with a 3D printed suppressor, and shot him once in the back and once in the leg. The defendant then fled northeast on 54th Street and took an e-bike uptown before getting into a taxi that took him to West 178th Street and Amsterdam Avenue. On December 9th, the defendant was spotted at a McDonald's in Altoona, Pennsylvania. The local police were notified. He was arrested, and he was found with a 9mm handgun, a suppressor, 2 ammunition magazines, and the same fake New Jersey ID he used at the hostel. I want to say a word about ghost guns. These weapons are increasingly proliferating throughout New York City and the entire country. Involving technology will only make this problem worse. Last year, over 80 ghost guns and ghost gun parts were recovered in Manhattan alone. The NYPD and the Manhattan DA's office have been leading in the interdiction of these ghost guns. And one thing I want to make clear, they're unserialized, they can be printed out, but as this case tragically makes clear, they are just as deadly as traditional firearms. This will remain a priority for us here in Manhattan. Finally, I know there have been questions about the extradition process. The latest that I can offer you is that the defendant is currently scheduled to appear in court in Pennsylvania on Thursday morning, first for a preliminary hearing on his Pennsylvania charges. Immediately to follow that will be an extradition hearing. We have indications that the defendant may waive that hearing, in which case he'd be brought to New York forthwith. In any event, we have been preparing on parallel paths, and before the hearing, we'll send to the governor of the state of New York the paperwork that would be necessary if he does not waive during that hearing. I now want to turn over to our great commissioner, and when I do so, I wanted to thank her for her partnership, not only on this matter, but on all we do every day together. Thank you.
That was Manhattan DA Alvin Bragg speaking at a press conference around Luigi Mangione, the shooter of United Healthcare, a CEO that happened just a few weeks ago. Mangione has been charged with first degree, 2 counts of second degree as an act of terrorism and intentional killing. You could look anywhere from 25 years to life when you put together all of these killings. There were other counts on weapon charges, but lesser charges as well. He's currently still in Pennsylvania. And on Thursday, we learned that he will have a preliminary hearing in Pennsylvania, and they're still working out whether or not there will be an extradition hearing as well. Scarlett.
All right, let's move on and take a look at our stock of the hour. We're keeping a close eye on shares of Tesla, riding high right now, and the stock outperforming after Mizuho Securities upgraded it to an outperform, citing an improved outlook under the incoming Trump administration. You could see they're up almost 4% on the day. Abigail Doolittle has more on this, and really this is kind of cementing the idea that Elon Musk and Tesla are in a good position to benefit from Trump 2.0.
Absolutely. Tesla, the stock, has certainly already been in a good position, up 92% this year. Earlier, from year to date into the spring, down about 50%. So wild volatility here, breaking out of a range. And something about Tesla is it's either going higher and people love Elon Musk, or it's going lower and people really dislike Elon Musk. There's not a lot of middle ground. So now that this new range higher has been created, it seems as though the new floor is probably closer to 300. We don't know that. But one thing we do know is this move, absolutely parabolic. In fact, Matt Miller and I back in July talked about this, and we created a chart that suggested something something like this could happen. But a 92% rally in, let's call it 8-9 months, some consolidation is needed. But much of this rally having to do exactly what you're talking about, the possibility that not just the stock going higher, because Carol and Tim earlier were making the point that President-elect Trump has already helped out Elon Musk. He's $200 billion richer. He's the official, most wealthy man in the world at $400 billion. But will regulation around the robo-taxi lessen? Will those tax credits that have been repealed for the other EV makers help out Tesla? It seems as though there's a lot of tailwinds. But again, if you look at the history of Tesla, those tailwinds at some point, it's almost the wheel of fortune. At some point they reverse and then go higher again.
But then if it's a Trump proxy, that kind of might change any sort of dynamic. Staying with cars for a second, we also heard that Nissan, particularly, and Honda might be talking about some kind of merger with. I thought was fascinating, and I wonder what that has to do with. Is it EV sales? Is it tariffs? Like, what is that?
Well, it's really interesting because the idea that you could have Hondas along with Acura, Infiniti, and Nissan all under one umbrella. But Nikkei is saying that a big reason, Tesla, the competition. They want to be able to compete better with Tesla, not just Tesla, but also the Chinese EV makers as well. So this space is really crowding up. Those talks in very early stages, so it could be some time before we hear an actual deal.
And of course, Toyota has been doing very well on the hybrid front too. So Toyota is a pretty formidable competitor at home.
Yeah, and they have the battery electric view, the BEVs, right? And the hybrid, and that's done really well. It's done really well here, too. All right, Abigail, thanks a lot. Really appreciate Abigail Doolittle joining us there. We're about 15 minutes away from the closing bell right here in the U.S. We're going to take you to those bells with Paul Christopher, Head of Global Investment Strategy at Wells Fargo Investment Institute, coming up next. This is Bloomberg.
Right now, we're really in a Goldilocks sort of situation, right? When we look at risk assets, we're in the perfect environment for them. We look at investment grade credit, we're talking about better liquidity, we're talking about, higher average credit qualities in that market. We're talking about shorter durations than we've historically had.
That was Stephanie Larosiliere, head of fixed income business strategy and development with Invesco, kicking off the show. She talks about a Goldilocks scenario. You have equities under a little bit of pressure, not much. The Russell 2000 underperforming, certainly the big cap indexes, and bonds doing absolutely nothing as we await the FOMC decision tomorrow.
But even if you look at the underperformance of all the major equity indices, you are still seeing tech relatively outperform, right? Like Broadcom's a different story. It's kind of leading everyone lower, but it also hit a record high yet again yesterday. So it's hard to take that necessarily a little bit too seriously. But, just take a look at the Russell and the mid caps. They're going to hit pretty hard, off by over 1%, despite the fact we're heading into a rate cut tomorrow.
I know. It's pretty incredible if you think about what Brian Moynihan, the CEO and chairman of Bank of America, talking about the economy being in good shape, the consumer doing well. You have a lot of red on the screen, so of course people are trying to price ahead to what they anticipate the economy might look like in 2025. Let's get some more perspective now and bring in Paul Christopher. He is head of global investment strategy with Wells Fargo Investment Institute. And to follow on that, Paul, I'm curious what you think about the increasing chatter we're getting about how perhaps the market feels kind of frothy at these levels. It feels like we're in a setup where you want to buy on rumor, and we've kind of seen that in the lead up to tomorrow's Fed decision, and sell on news as soon as the Fed makes its decision and releases its new projections for 2025.
Yeah, maybe. I mean, we wouldn't be in such a hurry to sell here. We think the economy's going to finish the year on a really strong note and take that note into 2025. We are expecting at least, tomorrow's rate cut and one more from the Fed. That's a great sort of expectation with inflation starting to bubble back up again. But we don't think inflation's a real threat. So you got a strong economy. Inflation, but not a real threat yet. And the Fed cutting rates, that's a pretty good combination to hang on to. If the market does get a little overextended, as markets do, we would be looking to buy cyclicals.
You'd be looking to buy cyclicals, but at the same time, Alex mentioned how breadth has been really negative. The market's run up the last couple of days, even weeks, has really been on the back of big cap tech names, and less so on broad participation by the other 493 stocks. So how do we justify going into cyclicals when right now people aren't seeing them as beneficiaries?
Well, you make a good point that the volume has been very thin, and that's also very typical. for mid to late December. But we think that volume comes back next year. And, whether tech continues to lead or whether you see some of that money rotate off, big tech is going to have to spend a lot of money. They're planning to spend a lot of money on data centers. That's going to take money away from investors. That's going to hit earnings a little bit. And you might see some of that money shake out. And as the economy goes forward here, look, the forward earnings multiple on the rest of the 4,993 stocks on the S&P is just about 20. Which is the 10-year average. So this is not an overbought market on a broad scale. That's why we think, aside from the kind of the weak volumes here, you've really got some buying opportunities, and you want to be selective and buy what looks attractive, not tech.
So if you like the cyclical call, the cyclicality also extend to small caps, just in terms of, say, the value trade, or do you need to stay in large cap cyclicals?
Yeah, that's a good question. So we went back to neutral. We've been heavily underweight small caps much of the year. Went back to neutral in August. We like the move. We're not trying to get overweight or get ahead of ourselves. Small caps still have some room to rise here, and we would rather be in a neutral position and wait to take advantage of that once we get into the new year. We think that small caps will benefit there, as well as the industrials, the energy, the financials on the cyclical side.
If you own tech, do you want to sell it or just not add?
Yeah, every time we get to a new high in tech, the Mag 7, take a little bit of profits, take a little bit out of those growth funds, turn that cash into something we think will help you in the longer term, which is to buy something that looks cheaper now and that has good prospects to outperform in the course of the next 12 months.
Paul, at what point would you consider looking overseas at some of the markets that have really gotten beaten up and have been ignored because the U.S. seems like it's the only game in town?
Yeah, it's that argument of U.S. exceptionalism is really hard to beat, and it's been hard to beat. But if I look at Europe, I see structural problems. If I look at Japan, I see big structural problems. If I look at China, I see maybe a reticence or a hesitancy to deal with the poor consumer demand on the part of the government. They really need some stimulus there, and producer prices are still falling. So wherever I look around the rest of the world, I see bigger problems than what we see here in the U.S.
Okay, so in equities, you want to stay focused on the U.S. What about in fixed income?
In fixed income, that's one where investors need to be very agile, because what we see is a lot of investors holding on to those CDs, those money market funds, and rates are coming down. So what we would be doing is first taking some of that cash and making sure you're overweight to your strategic allocations in large caps and focus on those cyclicals. The second thing we would do would be to move out in duration a little bit. You don't have to go out into the 10s and the 30s. There's going to be some ups and downs in bonds prices and yields, just as there has been this year, and that's going to hurt you more on the longer end of the maturity spectrum. So maybe stay in that 3 to 7 year range. The rates aren't that much different from the longer term, and you get whipsawed less when rates go up and down like they've done in the last several weeks.
Paul, are you a believer that the dollar is going to continue to reign here, talking about that U.S. exceptionalism trade?
Yeah, it will. And if we get to tariffs, that will help the dollar up even further. At some point, that becomes a headwind for some companies that do business overseas, U.S. companies, I mean. But right now, yeah, it looks like a stronger dollar, not just because of U.S. exceptionalism, but because of the likelihood of tariffs.
All right, Paul, we really appreciate it. Always fun to catch up with you. Paul Christopher, Head of Global Investment Strategy with Wells Fargo Investment Institute. Scarlett, we are making a run here off the lows. We're still down by 0.4% for the S&P, but we're well off the lows of the session as we head into the close.
Yeah, but I don't see this turning into a positive day either.
No.
There's no momentum really behind it. It's a move, yeah. I mean, in the last couple of minutes, you never know, but we have a situation where pretty much everyone has priced in this cut of 25 basis points for tomorrow. The big question is the dot plot, and the dot plot doesn't really hold that much relevance past its initial date. Jay Powell even said it as much.
Years ago, doing segments on, like, is the dot plot a thing? Do we need a fan chart? All of that. What everyone continues to talk about, though, is the lack of breadth. Charlie Miguel got over at Nomura talking about how funds are just buying upside calls and exposure into these concentrated names, right? You just cannot own enough of them.
Right.
And that widens the breadth issue, and then you have to buy more calls. So it's like this weird, catch-22.
Absolutely. And, by not doing it, you got FOMO big time, and people miss out on all those returns.
All right, well, we are moving closer to the closing bell. Full market coverage right here on Bloomberg Television.
The Closing Bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele and Scarlett Fu here. Romain Bostic is off today. We're helping you take us through the closing bell in a global simulcast. We're joined now by Carol Massar and Tim Senovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most critical moments of the trading day. Well off the lows here, Carol.
Yeah, definitely. But I'm watching, some buying here in the close. We're still in the red across the board, and it's really some broad-based selling today. But I've just noticed an uptick, certainly in those major equity averages here in the last, 20, 30 minutes of trading.
Okay, help me out here. Does it matter that the Dow is on its longest losing streak going back to 1978?
It matters if you're into cyclicals.
Does that matter?
It's breadth.
Does that matter?
Yeah, it's bad breadth. That's the issue. It's all about breadth, and that's the problem. That's what it's illustrating, no?
But given the composition of the index and the way that it's
It has NVIDIA now. It's up to date.
Yeah, but it's a price-weighted index, not a.
I don't think Tim likes it. Tim doesn't like it.
I don't know.
Tim's trying to give the Dow a little bit of love today.
I like it as a stat, but I don't know if I don't know if we should read into it at all.
I mean, on its own, I agree. I don't know that that's where we want to be reading into it, but I think Alex makes a good point, which is breadth is an issue, and for all the talk that, the rest of the market's catching up, it's not right now.
Okay, thank you, Alex.
Oh, you're quite welcome.
it.
Let's take a look at the S&P equal weighted index for a second, if I just bring that up. As you see the S&P and sort of tech rally off the lows, you're not really seeing that with the S&P equal weighted index. In fact, you're looking at the worst days since October 31st, lowest level since the beginning of November. And there you have the stats, guys. You got the S&P off by 0.4%, the Nasdaq off by 0.3%, Dow Jones, which Tim doesn't like, off by 0.6%. And you got the closing bells on this Tuesday, Fed Eve, guys.
Fed Eve, but this is already pretty much priced in. The S&P 500 down 0.4%, as we mentioned, so no record high. What did we stop at? I know you were keeping track of the number of record highs.
Oh man, I have an Excel spreadsheet at my desk.
59,
I'm
56?
No, I think it was like 57, but don't quote me on that, guys. I gotta check my chart.
You know what? This is the 5th decline in 7 days, so it's been a little bit of a,
It's a wobbly time.
Yeah, I don't want to say rocky, but yes, wobbly is a good way to describe it.
Interesting coming on, right? That BofA survey where it says everybody's kind of piling their cash into equities, which is a sign maybe of a top, kind of a contrarian indicator here. I'm looking at the S&P 500, guys. Most names in the index lower today. Scarlett, we're talking about 378 names in the S&P 500 losing ground, 122 to the upside, 3 at the moment unchanged.
All right, let's take a look at the IMAP. It's a lot of red. In fact, you only have one sector finishing in the green, and that's consumer discretionary. And it's barely in the green, up only 0.3%, and that's on the back of autos, namely Tesla. In terms of the big decliners, industrials, energy, and financials losing the most, with industrials down 0.9%. So there you go, Tim. There's your shout out to the Dow Jones Industrial Average.
Oh, much obliged. Thank you.
It's got to give them something. Tesla's up 93% year to date, and I think the move just off the election is just so impressive. Let's go to some of the individual gainers, if we may. Pfizer is the #1 gainer in the S&P 500 today, guys. It is up 4.7%, pretty much finishing at its highs of the session. The company coming out its 2025 guidance midpoint for adjusted EPS exceeding the average analyst estimate. BMO Capital Markets just among the analysts weighing in on this, calling the overall guidance reasonable yet achievable. On semiconductor, also among the gainers on my watch list, at its highs up more than 6%, finishing the day though with a gain of about 2% here. This is after the chip company and global auto components manufacturer Denso said they will strengthen their long-term relationship to support procurement of autonomous driving and driver assistance technology. Denso planning to acquire an undisclosed amount of onsemi shares on the open market as part of the collaboration. So On Semiconductor, the 4th biggest gainer in the NASDAQ 100. And then here, I want to go to Planet Fitness, finishing the day up just shy of 3%. $8.7 billion market cap fitness club company rallying after receiving a street-high price target over at Jefferies, which named the gym chain as its top pick for 2025 in the fitness and wellness sector. This one has been on a bit of a tear in 2024, up 40% year to date.
Okay. It's ready for those New Year's resolutions, I guess.
Well, also, it's just really cheap to go. So it's like you can just get it done and get out.
Is this the one that used to give free pizza?
Wait, Jim's giving free pizza? That doesn't sound right.
That seems a little weird. Have you guys never been to a Planet Fitness?
I have not.
I don't think so.
Oh, okay. Well, I represent. I mean, it's nothing fancy, no bells and whistles, but like you get the job done. Like it's like, the
it's all you
Walmart
need.
of a gym.
Hey, it's all you need, right?
Yeah, I don't need Equinox.
I want to get to some of the decliners on my radar today. I do want to start with NVIDIA, among the most actively traded stocks here today. Finished the day down 1.2%. They actually fell for a fourth day in a row. Shares down more than 12% from those all-time highs back in November. Now trading at its lowest going back to October. Still, though, take it with a grain of salt. NVIDIA up more than 160% so far this year. But over the last month, down 8%, while the SOX has been up 6.1%. And Broadcom's been up more than 40%. And speaking of Broadcom, it is a decliner on my radar today, down 3.9%. It had that massive rally after last week's earnings report. It's kind of like when NVIDIA shares first started to take off back in the early part of 2023. Broadcom shares have soared 38% from Friday through yesterday's close. That was the 2 days that since it reported results. It pushed the company's market cap to close to $1.2 trillion. Today, it did give back some of those gains, I should say. At one point, it was the biggest decline going back to September. Still, though, grain of salt, up 112% since the start of this year.
It's like everyone has decided it's the next NVIDIA.
Maybe.
You know, kind of the way they thought AMD might have been the next NVIDIA.
Or Supermicro.
Yeah.
Right?
But what's so interesting is that Lu Wang just had a piece out about the NASDAQ and the potential sort of rebalancing and says that whenever you wind up seeing these big guys dominate 48% and add up to 48% of the index, there needs to be a rebalance. And that just happened with Broadcom and its recent rally.
Oh, interesting. Okay, so a couple things happening at the same time. Finally, shares of CVS down more than 5% today. We saw other U.S. healthcare companies, in addition to CVS, fall because PBMs traded lower today. Pfizer CEO Albert Bourla came out and said that President-elect Donald Trump is, quote, very committed to PBM reform.
All right, bonds. Nothing.
Snooze.
That's it?
Snooze
All you
fest. Got nothing for you. There was a 20-year auction that went pretty well. It was pretty solid.
No one likes 20 years.
It's true. No one cared, but it was all right. It was pretty solid. We got nothing. There's nothing happening.
Maybe they're waiting. Maybe they're waiting for a Fed meeting or something like that.
Yeah, you know, even if you round it up, you maybe have a 1 basis point. Move. Maybe.
All right, guys. Well, having said that, I think we're all in on content today. A couple of stories on our radar. We all know that great line, "Nobody puts baby in a corner." We're talking about Dirty Dancing.
We're showing our age, Carol.
Kim, do you know this movie?
Of course I know this movie, yeah.
Alex, you know this movie.
Yeah.
All right. And if you don't know this movie, shame on you, everybody who's listening and watching right now.
There you go.
Anyway, the National Film Registry, apparently the Librarian of Congress since 1988, picks a bunch of movies, about 25 every year, and they put it into the National Film Registry. So Dirty Dancing, Beverly Hills Cop, and Up in Smoke among the films being put in for 2024.
I already know that Bluey is going to be put in there.
Oh,
jumping the gun.
Are you teaming me up for
The
this,
future Bluey
Kim?
movie. That's where I'm going.
Okay, you're teaming me up because
Yeah.
personally, I don't know why this is not the lead story on
Thank you,
every
Alex. I agree with you.
news station. Because
You're excited about this.
if
from the
you
morning.
have a child that's under the age of 15, you know, love, and adore Bluey. So apparently, Walt Disney is working with the studio arm of the BBC to release the first feature film based on Bluey. Apparently, it'll be released in the cinema in 2027. It's according to a statement on Tuesday.
It's a long time from now.
Yeah, and after, well, they got to get it perfect. And after it's run in theaters, the picture will become available in the entertainment's giant flagship Disney Plus streaming service, which also hosts the Bluey TV series. And if you haven't watched it, it is honestly the best kids show ever, and parents love it too. And the whole thing, it's very exciting.
So it features dogs, and I heard it's also good content for dogs.
What?
You mean for dogs at home, like to watch? So
Yes.
you leave them alone?
Apparently, the colors seem to help pets want to watch it. I don't know about this. I have not
blues and
confirmed this to
grays
myself.
Kids and pets, who knew?
How often is it on, Tim? How often is it on in your home?
Friday nights, Bluey's allowed. We're pretty strict with screen time, to be honest. But yeah, Friday nights, Bluey's allowed, and when mom or dad is out for the night.
Can I
Bluey's
just
allowed.
say, Devin Leonard wrote an incredible story earlier.
Cover story for
this
Bloomberg
year.
Business Week.
And he said it was the most watched kids show last year, according to Nielsen, the second most streamed show in 2023 after Suits.
Yeah.
Yeah.
A lot of that is parents, I can tell you that.
But
It's a great show.
it's serious, and they're really short 20-minute episodes, and to get a meaningful
8-minute episode.
Sorry, 8. I meant
Yeah.
with 2 of them, it winds up being 20. But it have a meaning, a point, a nice arc
Tim
for
knows
kids and for
everything
parents in
Bluey. I'm
minutes.
just telling you, Alex.
That is brilliant writing. What?
But I think one thing that I'm curious about is how they do this in 2027, because the kids are actually voice acted by kids, and those kids are growing up, so their voices are changing. So how are they going to keep those kids consistent.
AI.
And they're not. That's what also my dad said, Scarlett.
Yeah.
With the family's been talking about this a lot.
You can do anything with AI now.
I guess that's true. That's a good point.
But they keep the actual actors behind the kids' voices anonymous.
Super
so
secret.
We don't actually know who it is.
It's really great. For real.
All right. Oh, sorry.
That's a Bluey tag.
Maybe I'm like the Dora and Backyardigans considering for my daughter. All right, we gotta go. We gotta go.
For you guys.
All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place tomorrow for the closing bell.
All right, we say goodbye to our radio colleagues. We also say goodbye to Alex Steele. And coming up on the close, the Federal Reserve kicking off its last meeting of the year today, a conversation about what tomorrow's decision at 2 p.m. means for 2025. Torsten Slock, chief economist and partner at Apollo Global Management, joins us next. This is The Close. Welcome back to The Close. I'm Scarlett Fu. Let's take a look at where markets closed out on the day. You're looking at declines here in U.S. equities, although we did kind of rally into the close in that the major indexes paired their losses. And you have the S&P 500 closing down 0.4%. I believe this is the fifth decline in 7 days. So a bit of a stumble in the last couple of days here. Better than expected retail sales did little to support the stock market. And in fact, people are increasingly talking about the frothiness in equities. So I guess that leads us to wonder whether this sets us up for a buy on rumor, sell on news as soon as the Fed decision comes out tomorrow, although we're seeing a little bit of that selling now. No movement in the Treasury market up and down the curve, even with the 20-year auction. Two-year yield sitting at 4.24%. Bitcoin continues to hold firm, although it did get past $108,000. Right now, up marginally. And a big day for the loonie here. It's at the weakest since March of 2020. Canada is the latest government to slip into crisis following the surprise resignation of the finance minister. We'll talk about that a little bit later on. Let's also take a look at some of the day's big movers here. And I want to start with United Health. And it's not just United Health. We're talking overall these pharmacy benefits managers that are under pressure here after the CEO of Pfizer talked about how President-elect Trump is committed to reforming the companies, which he sees and he describes as middlemen. So that really suggests that the group is likely to be under a lot of political scrutiny in the next 4 years. So big declines here in Cigna, CVS Health, and United Health. Tesla shares climbing 3.6%. They did gain as much as 4.5% to a new high. The market cap topping $1.5 trillion. Mizuho upgraded its rating on the stock to outperform from neutral, citing an improved outlook under the incoming Trump administration. We have certainly seen that already with the blistering rally it's been on since Election Day. Our top story this hour is Starbucks facing a potential strike. The union, representing more than 10,000 of the coffee chain's baristas, has given the go-ahead for a possible work stoppage as the two sides get ready for a final round of bargaining talks. At issue, the union says the coffee giant has yet to bring a comprehensive economic package to the table, with pay as one of the key outstanding issues. Later in the program, we'll be speaking with Michelle Eisen, bargaining delegate for Starbucks Workers United, as well as a barista. But in the meantime, we want to stay focused on the labor market because the strength of the job market continues to be a key point of contention for the Fed as we look ahead to tomorrow's big decision. Joining me now for more on what the Fed does and the state of the U.S. economy is Torsten Slock. He is chief economist and partner at Apollo Global Management. Torsten, always a pleasure. Thank you for joining us today.
Thanks for having me.
Before we get to the Fed, I want to get your take on the retail sales report, which I mentioned as being strong, but not doing much to help the market. Retail sales rising more than expected in November. Car purchase is a big reason why. There's been a lot of talk, I guess, in Reddit forums and whatnot about how retailers were kind of encouraging consumers to buy more before inflation goes up, before tariffs hit products and people see the price tags of everything go up as well. Do you see any evidence of that happening?
Well, when you do look at the components, you do see some of that happening. But what's very striking is that it was the most interest rate sensitive part, namely car sales, that continues to be quite solid. What you would have expected is that when the Fed began to raise interest rates, car sales since 2022 should have gone down. But the fact that car sales for the last 2.5 years, including in the numbers that came out today, have continued to be so strong is telling us that the consumer is still having plenty of money to spend, not only coming from incomes because of the low unemployment rate, but also because of the wealth effect effect from home prices still being very high, stock prices still being very high. Across the board, the asset price effect on household balance sheets continues to be strong. And at the same time, because yield levels are so high, interest rates are so high, the cash flows people get, including in private credit, in fixed income, is very, very strong. So all that is pointing towards still continuous strength in consumer spending, including in the data that we just saw today.
Yeah, there's definitely consumer spending on products, on goods. But what about services? Because spending at bars and restaurants fell for the first time since March. And we know that grocery stores also saw declines as well. So there is cutback taking place.
There is probably some prioritization, and maybe this just has to do with that we're getting into the holiday period where people do some things in November, and there's always something about when is Thanksgiving and when is it measured. So you're right, we are watching very carefully the different components relative to goods versus services. But the big picture, at least in the GDP data, is that for the last 6 months, the consumer has been very, very strong. We saw GDP, of course, in the second quarter at 3%, and in the third quarter 2.8%, and the Atlanta Fed GDP now is at 3.3%. So there is really not much sign of a slowdown also when it comes to the consumer.
How do you see Jay Powell folding in the strength of the consumer into how he responds to questions about where the Fed sees the economy and inflation going in 2025? Well,
that's really exactly the main question at the moment, because the dual mandate, you have inflation certainly has come down. It's come down from 9 to now around 3, 3.3 on core CPI. So you could say we've come a long way in terms of getting inflation to come down. But 3.3 is still not quite the 2 that they have as inflation target.
Exactly.
So yes, they have come down on that, but on the growth front, we still have strength across the board when it comes to exactly consumption, to durable goods, meaning capex spending. We also have government spending has also continued to be relatively strong. So it really is this very delicate balance between where does Jay Powell tomorrow put the weight? Does he put the weight on the dual mandate on inflation has come down, that means we should be cutting rates? Or does he put his weight on, hey, GDP growth is still strong, the economy is still strong, so maybe we should be stopping with the rate cuts?
You see a rebound in inflation. I mean, you talked about how it's come down a lot since 9%, but nowhere near that 2% target, which at one point was amended to 2-ish%. But
exactly.
This is a case in which we're starting to see inflation move in the opposite direction again, the wrong direction.
Well, since the beginning of the year, if you look at some of the measures that try to measure the stickiness of inflation, so the New York Fed has a measure of inflation persistence, that's around 3. The Atlanta Fed has various measures of sticky CPI, including shelter, that's also around 3. In some cases, some of these measures, when you look at the median and the trimmed mean, they are closer to 4. So the first conclusion is he really has this difficult challenge tomorrow that inflation has come down, but it's just not come all the way down to 2%. So the question is, does that warrant more Fed cuts? Or is this the time to say, maybe we shouldn't be cutting that much? And I think that the market is right in assuming that we will have fewer cuts now over the coming period until the end of next year, relative to what the assumption was earlier this year. So rates higher for longer to keep making sure that inflation is absolutely on a sustainable path down to 2%.
What are you projecting in terms of how many rate cuts we'll get in 2025?
So we are projecting that we'll get one tomorrow and then we'll get one next year. But we think that there's
one cut in 2025.
Only one cut next year. But we think that the risks are rising, that if you layer on top of this strong economy at the moment, again, Atlanta Fed GDP saying we'll have GDP in the fourth quarter of 3.3. And we also still have inflation, core CPI 3.3, headline is 2.7, so still around 3. And now you add Trump policies with potentially lowering corporate taxes for domestic manufacturers to 15%, potentially something on tariffs, potentially also some restrictions on immigration, maybe even deportations. These 3 policies, if they do come in any shape and form, will all unambiguously putting upward pressure on inflation. So the risks are rising that inflation is actually beginning to move higher as we get into 2025, including also for residual seasonality reasons at the beginning of the year that also could potentially give a lift. So we are definitely not out of the woods when it comes to having inflation under control.
So that would mean that maybe there's room for a rate increase?
So that's not our baseline, but I definitely look at the market's expectations on VERP on my Bloomberg screen, and I see that the market has been taking the swoosh more back to a straight line with, therefore, just a few more strong numbers, in particular on inflation and also on the employment report. Then I do think the Fed next year could come to the conclusion that maybe they do have to hike again.
Okay, stay put. Torsten Slock is sticking with us. He is chief economist and partner at Apollo Global Management. Coming up, we're going to talk about the top three movers and shakers at the center of the day's big stories. This is The Close.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line, we just ran for the last fiscal year in the United States an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect.
That was Bank of America Chairman and CEO Brian Moynihan speaking with our David Weston earlier, talking about whether the U.S. economy needs more stimulus. Torsten Slock is still with us. Torsten is chief economist and partner at Apollo Global Management. And, that's a good question, how Scott Bessent, who is the Treasury Secretary nominee, is going to fit tax cuts, immigration reform, tariffs in with spending cuts when a big chunk of our debt is tied to things that can't be touched.
Well, that's why the question, do we need more stimulus, has two parts, namely, well, does the economy need more stimulus and can we afford it? And we know, of course, that debt levels are very high, deficit levels are very high. So in some sense, if we add more Treasury issuance across the yield curve, that begins to raise more questions about auction sizes, what will have to be to cover ratios we saw, including today. Some challenges when you begin to see auctions tailing, in particular further out the curve. That raises some risks around what's going to happen if you have a lot more treasuries that need to be issued. And for the economy, it's definitely the case that the economy is very strong at the moment. GDP last quarter was 2.8. Atlanta Fed this quarter says 3.3. Remember, Congressional Budget Office thinks that GDP growth in the long run is 2. So anything above 2, and all those numbers are above 2, tells you that we still have strong, steady momentum in the economy as we go into 2025.
At what point does the bond market start to really protest what they're seeing? I mean, we've gotten bits and pieces, but not really. It's happened in other countries, but not in the U.S.
No, so far so good. And I do not expect that we'll have a debt crisis in the U.S. But I do expect that as we continue to see more issuance, you should expect to see the yield curve steepen further. You should expect to see the term premium go up, and you should also expect to see long rates gradually move higher. Over the last week, we've seen quite a move in 10-year and 30-year rates, basically on no news. There was last Wednesday, the CPI report came out at 8:30, but if you look at the chart, that was only a very small wiggle, but there's a significant drift coming along in rates moving higher, and that's beginning to raise some questions about why is it rates are going up over the last week or so on no news? What is it that the market is beginning to take into account? Is it because of issues about the fiscal sustainability, or is it because of the strength of the economy?
How are you thinking about that answer?
So I think that both are playing an important role, but it certainly becomes very critical to this discussion about the fiscal outlook. Is there any path out of this? And the Penn Wharton budget model has done some simulations where you can actually grow your way out of this simply by expanding GDP in a very substantial way, including through various ways of including both capital and labor getting a lot bigger. So there are ways of dealing with this, but it is, of course, quite a political challenge, and it does become a very important issue in 2025.
Yeah, all to be put on the to-do list for 2025. Torsten Slock, chief economist and partner at Apollo Global Management. Let's transition now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ned Segal. He's the former CFO of Twitter. He's moving to the public sector. He will serve as San Francisco's chief of housing and economic development under the incoming mayor, Daniel Lurie. That's according to the information publication. Segal is reportedly interested in exploring ways for residents and small businesses to move to the downtown neighborhood of San Francisco. Next up is Elizabeth Warren, the Massachusetts senator challenging the incoming president to set ethics guardrails to address the, quote, massive conflict of interest posed by Elon Musk. In a letter to Trump, Warren points to SpaceX and Tesla's contracts with the U.S. government, not to mention the fact that there are several federal investigations into companies that Elon Musk runs. Musk, by the way, did not immediately comment on Warren's letter. And finally, a twofer. Ralph Macchio and Jackie Chan, they're teaming up on a new Karate Kid movie next summer. Sony released a trailer for Karate Kid Legends. which will hit the big screen in May of 2025. I think Memorial Day weekend, in fact. Ralph Macchio reprises his role as Daniel LaRusso from the original trilogy made back in the 1980s, while Jackie Chan will play Mr. Han, who was introduced in the 2010 Karate Kid remake that stars Jaden Smith. I was unable to confirm whether Johnny Lawrence, who is played by William Zabka, will be in the new movie. Of course, he's in Cobra Kai, the Netflix series that Ralph Macchio spearheaded. So this Karate Kid franchise has really grown, and it takes form with Karate Kid Legends. I did not know that this was coming up. In any case, coming up, we're going to stay with brand names and talk about Starbucks, because the union representing thousands of Starbucks baristas has given the go-ahead for a possible strike. We're going to get more details on what this means for the coffee giant. This is The Close on Bloomberg. Organized labor taking aim at Starbucks. The union representing the chain's baristas has voted to authorize a strike if necessary, with 98% of its members voting in favor. Starbucks Workers United claims the company has, quote, yet to bring a comprehensive economic package to the bargaining table. No decision has been made on whether workers will actually strike or when. Joining us now for more on this developing story is Bloomberg's Daniela Sirtori. So, Daniela, how did we get to this point?
So, Starbucks had been sort of locked in a fight with the union since December 2021, when the first store voted to unionize. There were accusations of stonewalling and other activities to sort of quash the union, which the company denies. But actually, starting earlier this year, the parties went back to the table and started actually bargaining to reach, the framework of a contract. And, at least publicly, the negotiations had been going pretty well. But as of today, we did get news that, baristas do feel that, Starbucks has yet to come to the table with what they call a meaningful economic proposal. There are also other legal issues that have to be resolved. And so the union said that they had authorized a strike that might happen if basically there's no meaningful movement when it comes to the bargaining.
And of course, since they first began discussing things, there's been a change at the top of Starbucks. There's a new CEO. The old one is gone. Do you think that has anything to do with this change in tone?
Hard to tell at the moment, but it is true that the sort of pivot that Starbucks had, they went from sort of really opposing the union to at least engaging, did happen under the prior CEO. So, Brian Niccol coming in as the new CEO did, inject some uncertainty into the process, because you never know, what kind of approach a new executive is going to take. Absolutely. So what will you be looking for going forward, Daniela? Well, I think it's going to be really important to see if, there's actually a strike, right? Baristas have said that they will strike if necessary, right? That means if they feel that there's no meaningful, movement or progress being made in terms of the contract. Ultimately, the goal is the framework of a contract. That's what baristas have been pushing for a couple of years. So really, that's kind of what I have my sights on. Okay. And when we talk about this Starbucks union, what share of overall baristas does it include? It's about 5% of the company's more than 200,000 baristas that work in company-operated stores in the U.S. I will say that even though it's a small fraction of workers, it is meaningful when it comes to compares to other efforts to organize retail workers. And the union has also been very vocal to a point in which sort of the tensions and the attention have definitely spilled over beyond just the that 5% of represented workers. Absolutely. Daniela, really appreciate your joining us and giving us the context that we needed to understand the story. Daniela Sirtori with Bloomberg News. We're going to stick with this story because right now joining us is someone who is directly involved with these negotiations. Michelle Eisen is bargaining delegate for Starbucks Workers United. She is also a Starbucks barista. Michelle, thank you for taking the time to speak with us. You heard the setup that Daniela provided. I guess the first question I have for you is, after months of what seemed like productive conversations, it seems like negotiations are once again tense. What changed?
Well, this is always what it was going to be. We were always here fighting. We're at sort of the 11th hour. We're waiting for the company to come to the table with anything relating to economics in a fair, comprehensive way. They keep saying they're going to show up with a comprehensive economic package. We have yet to see that. And we need them to know that we're serious. They need to resolve the hundreds of unfair labor practice charges that are still outstanding. That was part of what they said this deal was when they came to us in February and we started negotiations up again. This was part of the deal. It's a lot of those outstanding ULPs involve, back pay. Millions of dollars of back pay that are owed to these union workers that was withheld from them. So we need a comprehensive economic package. The company has yet to show that. We need them to come to the table with that. And we need guarantees that the outstanding unfair labor practice litigation is resolved so that we know that they're serious about a partnership with the union.
You mentioned back pay. I take it the single most important issue, outstanding issue, really is pay. So if you could help me understand the union's thinking here. Is the union looking for a specific level of pay, or is it looking for a minimal percentage increase in pay?
Well, we know that the company has invested just this year. They invested in a new CEO whose compensation is approximately $57,000 an hour, which is about $10,000 times more than what the average barista makes an hour. The investment needs to go to the workers. We agree that we need management, we need people, in the company that can make great choices, but those choices have to relate to the workers in our daily lives and what we bring to the table, what our worth is in this company. I have a hard time believing that the CEO of this company works 10,000 times harder than I do or any one of these baristas does on this floor. So it needs to be sort of fair equivalent to what we offer to the company.
So what is that level? Is there a minimum level?
I can't go into specifics of what we've already come to the company with what we feel is a fair wage increase. And we've used a lot of their own data to reach those conclusions. What we do know is what we're being paid now is well below what we feel we're worth. The company did just announce company-wide raises fairly recently, just last week, in fact. I can tell you that I've been with the company 14 years, and I was just given a 61-cent increase in my pay. And that's more than a lot of other baristas got. If that's fair and the company can somehow justify that, I'd like to hear it.
I see. Well, there are other things that the company will say that it's offering, right? Because yesterday it expanded its paid parental leave policy now for U.S. store staff to 18 weeks for birth parents and 12 weeks for other new parents. Basically, store staff now get the same kind of paid parent leave as corporate employees. Is this something that the union had been asking for? I'm trying to understand whether this or how this fits in with your demands.
In fact, at our last bargaining session, it was the union who put that proposal on the table after we were able to discern that corporate level Starbucks workers received 3 times the amount of parental leave than your, hourly workers on the floor, which is just mind-boggling. We heard from one of our delegates who was a newer mother who sat across the table and said, how can you tell me that your time with your child is 3 times more valuable than my time with my child? And then lo and behold, the company goes and announces that they're extending that expanded parental leave to all of the Starbucks workers. That's amazing. We are counting that as a union win. It's hard to believe that that was just a coincidence that the company was going to grant this all the time. And, within 3 weeks of us bringing it to their attention, all of a sudden, it happened. So yes, we are counting that as a win, but it is just one ask. And we need some guarantees. And we want those guarantees in the form of a signed contract.
Okay, I hear what you're saying. I'm curious about your impressions of Brian Niccol, the new CEO of Starbucks. Have you met with him personally? Have you talked with him? How involved is he in this current negotiation?
I have never met with him. He's never been present at any of our negotiation sessions that I am aware of. I would assume that he's pretty involved, holding the position that he is holding. But he, to the best of my knowledge, has not had any direct communication with the union.
Okay. Michelle, what would be your message to shareholders, to investors, potential investors of Starbucks who might be listening to this conversation? What do you want to tell them?
I think I would want them to think back to what Starbucks used to be. We know that, one of the things that the new CEO has said that I do agree with is this sort of back to Starbucks initiative, or this turnaround to bring back the culture that the company once had. And the most integral part of that culture are the baristas on the floors in these cafes. When our stores were staffed properly, most of the issues that you are seeing that the company has admitted are current issues, staffing issues, long wait times, cleanliness, quality of beverage and food, those issues were minimal when the company was investing in their workers the way that they did at one point in time. We're just here trying to solve some of those issues with the company, issues that the company has admitted need to be solved. We're here in good faith. Hundreds of hours of bargaining have gone into this contract so far, and we're incredibly proud of the progress that we have made, but we haven't crossed the finish line yet. And we need the company to commit to investing in our workers. And of course, that comes in the form of wages and benefits. It absolutely comes in the form of resolving these unfair labor practice charges that are still pending. We need assurances that we are, in fact, in a real partnership.
All right, Michelle, really appreciate your joining us today. Michelle Eisen is bargaining delegate for Starbucks Workers United and a longtime Starbucks barista. Let's just recap what happened in equity markets today on this Fed Day Eve before the Federal Reserve comes out with its interest rate decision tomorrow at 2 p.m. A decline in equities across the board here before that Fed decision, down 0.4% for the S&P 500. No move in the Treasury market. Bitcoin continues to gain, although the gains have moderated here. And the loonie under pressure. Canada dealing with a government in crisis. This will be our next topic of conversation. This is The Close on Bloomberg. Another G7 country's government is on the brink because of a budget controversy, and this time it's Canada. Finance Minister Chrystia Freeland shocked Canadians when she announced her resignation on social media yesterday. This over differences with the Prime Minister Justin Trudeau over how to prepare for the Trump administration. Joining us now for more on this is Brian Platt, Bloomberg News Canada government reporter in Ottawa. So, Brian, how important was Chrystia Freeland to the Trudeau administration? Because I remember her from the first time Trump was in office, and she was the chief negotiator for Canada in the USMCA.
She was incredibly important. I mean, she became finance minister in 2020. At that point, she was a trade and then maybe also a foreign affairs minister during Trump's first term. But she was finance minister, she was deputy prime minister, but she took on all the big, sensitive international files of this government. China tariffs, Russia's central bank assets, and of course, U.S. trade. And she was a very close and trusted ally of Trudeau. This relationship breaking down, and for Freeland to quit, and not just quit, but really slam the prime minister, this is a huge loss for Trudeau. It has really damaged him, and it's a big loss for the government.
Yeah, she basically threw him under the bus with her letter on social media. What does this say about how united Trudeau's cabinet is, and beyond that, the Liberal Party, and whether he can survive?
It's a huge question. I believe this has put more pressure on Trudeau. This has damaged him more than anything else in his 9 years as prime minister so far. There's an election sometime next year for sure. It has to happen by October. We have a parliamentary system, so it could come sooner than that. This is, I think there is now a real question over whether Trudeau can make it to that election, or whether the fallout from how Chrystia Freeland quit and then attacked him on her way out damaged him so much that if he doesn't resign as leader, his own party, I think it's very possible, could force him out in the coming days and weeks. Okay, so it's a ticking time bomb, certainly. What happens, and what does this mean for Canada's negotiations with the incoming Trump administration over tariffs? The president-elect has threatened to impose 25% tariffs on Canadian goods, and Justin Trudeau did travel to Mar-a-Lago to speak with Trump in person. Yeah, it's very damaging because, as you said in your intro, I mean, Chrystia Freeland was the main Canadian minister who was leading Canada's negotiations over free trade with the Trump administration in Trump's first term. She's gone now. Her experience in that and the relationships she built up in that are gone. Now, I will say many people around Trump don't like Chrystia Freeland, but that's in part because they say she was such a tough negotiator. She was a very formidable presence across the table. There's the person who will now, I think, largely take over that role for Canada is a minister named Dominic LeBlanc, who has now been named finance minister, and he was with Trudeau on the plane when Trudeau flew to Mar-a-Lago, and Dominic LeBlanc dined with Donald Trump and has been in charge of trying to beef up the Canadian border to to pacify Donald Trump enough on this issue to get the tariffs gone. So they do have somebody else in place to take this over, but I think it's not only do you lose Freeland, but your government also just looks to be in chaos right now, which is not helpful.
Yeah, so I imagine a lot of analysts are talking about the possibility of President-elect Trump trying to capitalize on this moment of Canadian political angst, trying to press his advantage.
And he's already been mocking Trudeau quite a bit with the whole joke about Canada being a 51st state. He put a post up on his social media last night celebrating Freeland's departure, saying that she was a very toxic person, but again, referring to Justin Trudeau as Governor Justin Trudeau. He's really trying to rib and mock Trudeau a little bit here, which is, that Trump likes to troll other politicians. This is not necessarily a new thing. But the chaos, the sense that Canada is not a united government right now, I think it's hugely damaging and makes it hard for Trudeau to have a serious negotiating position at the moment. Now, we'll see how fast he can recover from this.
Brian Platt joining us from Ottawa. Thank you so much, Bloomberg's Canada government reporter. And of course, we've seen the Canadian dollar come under pressure along with Canadian bonds. And it's a similar story over in a country like Brazil. Crédit Agricole has exited its tactical overweight position on the Brazilian currency 2 weeks after entering that trade, seeing no technical resistance for how much the currency can fall. Joining us now to discuss all of that is the analyst behind that call, Olga Yangol. She's the head of emerging markets research and strategy for the Americas at the Crédit Agricole Corporate and Investment Bank. Olga, thank you so much for joining us. You look at the Brazilian real, it's in free fall. It's down, I think, 20% so far this year, at a record low versus the dollar, forcing the central bank to intervene and sell the dollar to prop up the currency. What's going to stop this spiral?
The key issue in Brazil is fiscal. And what we're observing is that the central bank, as much as the central bank tries to respond with a very hawkish rate decision last week and intervene over the past 3 sessions, there is only so much it can do. Unless the fiscal issue is addressed, the pressure on the BRL should continue.
Okay, so I guess then that comes back to Lula, the president. He's 79 years old. He had emergency brain surgery last week and is now back in office and doing his job, which is kind of mind-boggling. He needs to address the fiscal situation, the budget deficit specifically. He needs to get big spending cuts passed. Is he capable of getting this done from where you sit?
It's not so much about the ability, it's about the willingness. And what we've seen so far, the economic team did present a package, which was, I would say, on the surface was perhaps a little bit more optimistic versus what the savings that I think we could reasonably expect from that package. And at this point, with 3 days left until the congressional recess, we do expect that package mostly to be approved, but we don't think that we're going to get much more than that. And what that means is that Brazil is unlikely to meet its primary balance target next year or until 2026 when we have the election.
Okay, 2025, 2026, that sounds like there's trouble ahead. The real's weakness is spreading to other assets like U.S. dollar-denominated government bonds. Do you worry that Brazil is becoming uninvestable for foreign investors?
I think perhaps that's probably going a little too far. I do think that Brazil will muddle through. However, at this point, long-term bonds, be it local bonds or dollar bonds, are a dangerous place to be. Brazil is a country with still attractive growth prospects. The central bank is there, and the fiscal package that I think that will get passed will help prevent the debt to GDP from spiraling. So I think that we cannot say that it's uninvestable. It's investable.
Is investable. And you mentioned, of course, that there is still a lot that Brazil can offer. And I'm thinking of commodities, for instance. There's a lot of talk about with the U.S. economy remaining strong and China enacting some stimulus that perhaps that will keep demand for commodities that Brazil produces strong. And would that be something that could help kind of stem the tide here and reverse Brazil's fortunes?
That's right. I would say that the key differentiator for Brazil among other countries in the EM, it's a relatively closed economy, self-reliant, and it does not depend so strongly on any one trading partner. It doesn't trade that much with the U.S. compared to other countries in the EM. It does trade with China. So to the extent that China is able to support its economy, it will help Brazil. But in general, there is enough internal momentum within the Brazilian economy that it should continue to grow.
What will you watch for in the next couple of days and weeks here to determine whether the fall in the real can be stemmed?
So number one, of course, the response of Congress. Will the proposal of the economic team with respect to expenditure cuts be approved? We think it will be, but it's not guaranteed. The timing is short. And of course, the interventions of the central bank will be helpful, but at this point, it's really about the fiscal.
It all comes down to the fiscal situation, of course. Olga, thank you so much for joining us today.
My pleasure, anytime.
Olga Yangol of Crédit Agricole Corporate and Investment Bank. Now, still ahead, we're going to set you up for what you need to watch for tomorrow's trade, starting, of course, with the big Fed decision at 2 p.m. This is The Close on Bloomberg. All right, let's look ahead to Wednesday and tell you what we're watching on the calendar. Before the market opens, we've got more earnings. General Mills, the cereal company, will be reporting results. This is a stock that gained 0.5%. Consumer staples, of course, seen as a defensive kind of investment in this current environment. And then we're going to move on to mortgage applications at 7 a.m. And that kind of teases up for some housing data overall. Housing starts and building permits come out at 8:30 a.m. before the market opens. We're looking for a 1% increase in building permits for the month of November. And then at 2 p.m., the FOMC rate decision comes out. Economists are expecting the Fed to cut rates by 25 basis points. And then 30 minutes later, Jay Powell will host his press conference where he will answer questions on the outlook for 2025, certainly the dot plot and what they project for inflation, employment, as well as GDP and the pace of rate cuts. And then after the market close, more earnings. Staying on that home theme, home builder Lennar will be reporting along with Micron, the memory chip maker, and office furniture maker Miller-Knoll reporting after the close as well. That does it for us. Balance of Power is up next. Have a great evening, everyone. This is Bloomberg.